Okay, hello everyone, and today what I want to talk about, one of the biggest problems people have when they start researching annuities and retirement planning online. What we find is that typically people will find 3 or 4 different sources, maybe 1 or 2 local guys, a couple different online resources, and they'll start doing a lot of research, and by the time they get to us, they seem like they're really confused by all the options. Everything, it just seems to be a mess of information, and they can't really make sense of a lot of it. So what we like to do at AST is boil things down and make them as simple as possible. So if we're talking about safe money, then there really are only a few options out there to truly protect your assets. And so we're going to run through those safe money options and talk about how each of those compares to each other. Okay? So the first one everybody knows about is a savings account or a money market fund. And those are typically going to pay you about 0.5% interest if you're lucky. Okay? So there's not a lot of yield there, but a lot of liquidity. The next thing is if you go to a bank, they're going to tell you to buy CDs. CDs, in the time frame we're looking at planning for, we like to look at a 5 to 7 year time frame, real short term because of low rates. And let's say that CDs are going to pay approximately 2% interest. And it could be more or less, just depending on where you get it, but just for argument's sake, we'll call it 2%. Then the money managers are going to want to talk about the kind of the classic safe money asset, and that would be bonds. And you could talk about government bonds, corporate bonds, different ratings, even municipal bonds. But generally speaking, bonds in the 5 to 7 year time frame are going to pay about 2.25% interest. So a little bit better than CDs, but they also, just like anything else, come with their own set of risks and a bunch of downsides. Okay. After bonds, we're going to get to fixed annuities, just plain old fixed rate, boring annuities. And those are going to pay you for the same time frame, roughly in the neighborhood of about 2.75%. Okay, fixed annuities are just like bonds, and you're going to have you'll have a little bit of liquidity. You'll have a few downsides to it. There are pluses and minuses to every strategy. So after fixed annuities, the next best yielding opportunity in this asset class for safe guaranteed money would be secondary market annuities. We don't talk a lot about those except for in a one-on-one scenario with planning for individuals, but secondary market annuities offer a higher yield and the same guarantee as an annuity. If it's right for you, we'll certainly get into that. Last on the list that I would say is what most of you have heard from other people, and that would be a fixed index annuity. Now, a fixed index annuity is not guaranteed to yield higher than any of the other alternatives, but it does have some liquidity privileges and some protection against interest rate risk that the others do not. What you get with an index annuity is you get a guarantee of your basis, so you're guaranteed to never lose money, and you have potential to increase your yield over and above what the other safe money options would provide. So it's certainly possible and does happen where an index annuity will yield you 5, 6, 7% interest in a given year, but that's not guaranteed every year. Now, once you get to that point, once you get the 5 or 6% interest, it is locked in and guaranteed just like the basis, but it again comes with its own set of downsides. So in an individual plan, you have to decide really what's best for you. And any of the products we talked about, so what do we have here? We have money market funds, CDs, bonds, fixed annuities, secondary market annuities, and finally fixed index annuities. That is really all we're talking about when it comes to safe money. So you can simplify the options and think about it in those terms no matter what anyone else tells you. And any of those assets, any of those 6 assets that we talked about, can be used to create an optimal managed portfolio if you simply want to manage your money for growth long term and a little bit of safety for liquidity, and they can also be used to create a really good income strategy. Any of those products can be used. We have our favorites, we have our reasons for doing the ones that we do, but when we give you an analysis, we take into account how each of those would produce the result that you want, and you simply get to pick the right one, okay? In the end, a lot of times that means that you aren't going to buy an annuity from us, and that's okay. We have a fiduciary duty to do what's best for you, and that's really the only result we look for. Okay? If you decide to buy a CD at the end, good. At least you're going to do it for the right reasons and knowing exactly what your scenario is and what that product's meant to deliver. So thank you for your time. I appreciate you stopping by, and we'll see you again soon.